Something unusual is happening in the global gold market. Right now, at this very moment, the same bar of gold trades at meaningfully different prices depending on whether you're buying it in Shanghai or London. This isn't supposed to happen. Gold is the ultimate global commodity, refined to identical standards, traded around the clock, and moved constantly between financial centers. The arbitrage mechanisms that keep prices aligned across continents have worked efficiently for decades, but those mechanisms are showing signs of serious strain. This phenomenon has a name among traders: the Shanghai premium. And in recent months, that premium has widened to levels that suggest something fundamental is shifting beneath the surface of the world's oldest financial market. The question isn't just why Chinese buyers are paying more for physical gold than Western buyers. The real question is what happens when the world's largest gold consumer begins operating in a parallel pricing universe, and whether the infrastructure connecting East and West can handle the pressure. The stakes extend far beyond bullion dealers and commodity traders. When the price discovery mechanism for a $13 trillion asset class begins fragmenting along geographic lines, it signals potential instability in the broader financial architecture that underpins international trade, central bank reserves, and monetary policy itself. Understanding this dislocation requires looking at the physical realities of gold movement, the regulatory frameworks governing different markets, and the economic forces driving unprecedented demand in the world's second largest economy. For most of modern financial history, gold has traded in what market participants call a unified global market. The London Bullion Market Association sets the standards. Major banks provide liquidity. Futures contracts on COMEX in New York establish price benchmarks. Physical gold moves between vaults in London, New York, Zurich, and other centers with relative ease. Arbitrage traders monitor price differences measured in pennies per ounce, ready to exploit any meaningful gap by buying in the cheaper market and selling in the more expensive one. This constant pressure keeps prices aligned within narrow bands, typically less than $1 per ounce after accounting for transportation and insurance costs. The Shanghai Gold Exchange, established in 2002 and significantly expanded in 2014 with the launch of the Shanghai International Gold Exchange, operates differently. It requires physical delivery for all contracts. There are no paper settlements, no cash alternatives. Every transaction ultimately involves actual metal moving into or out of designated vaults. This physical-only structure creates immediate consequences when demand surges. You cannot simply create more contracts to satisfy buyers. You need actual gold bars, refined to Chinese standards, delivered to approved locations within China's borders. The premium emerges when this physical demand exceeds the rate at which gold can be imported and delivered. In a frictionless world, arbitrageurs would immediately ship gold from London to Shanghai, capturing the price difference as profit and eliminating the premium in the process. But the world of physical gold is far from frictionless. Import licenses must be obtained. Refining may be required to meet Chinese purity standards, which specify 99.99% gold content compared to London's 99.5% good delivery standard. Transportation takes weeks. Insurance costs money. Most critically, China maintains capital controls and regulatory oversight of gold imports through designated commercial banks, creating bottlenecks that cannot be eliminated simply by throwing more money at the problem. Throughout 2024, the Shanghai premium fluctuated between $5 and $25 per ounce for extended periods, occasionally spiking above $40 during periods of intense buying. By late 2024 and into early 2025, the premium has periodically reached and sustained levels above $30 per ounce, with some trading days seeing gaps approach $50. To put this in perspective, these spreads represent 1% to 2% of gold's total value, magnitudes larger than the typical spread of 0.1% to 0.1% that prevailed for most of the 2010s. For a market that prides itself on efficiency and where professional traders compete to exploit fractions of a percentage point, these are extraordinary numbers. The persistence of the premium tells us something important. The obstacles to arbitrage are not temporary or easily overcome. They represent structural features of how gold moves between regulatory jurisdictions, how China manages its financial borders, and how physical logistics intersect with financial flows. When premiums persist at these levels for months, it indicates that the profit opportunity from arbitrage is being offset by equally large costs and risks, or that the channels for moving gold are operating at or near capacity. The willingness of Chinese buyers to pay a significant premium reveals extraordinary demand dynamics. This isn't speculative excess or irrational exuberance. Multiple factors converge to create sustained physical gold demand that exceeds available supply at Western prices. Understanding these factors requires examining both economic conditions within China and the cultural and regulatory context that shapes Chinese investment behavior. China's property market, which has represented the primary store of wealth for Chinese households for 2 decades, has been in a state of distress since 2021. Major developers, including Evergrande, Country Garden, and dozens of smaller firms, have defaulted on obligations. Residential property prices in major cities have declined 10% to 20% from peak levels in 2021. New home sales have fallen by more than 40% compared to the pre-pandemic period. For Chinese households that traditionally allocated 60% to 70% of their wealth to real estate, this represents a fundamental disruption to their wealth storage model. Simultaneously, Chinese equity markets have disappointed investors despite occasional government-driven rallies. The CSI 300 index, a benchmark for large-cap Chinese stocks, traded at levels in late 2024 that were below where it stood in 2021 despite brief surges. Regulatory crackdowns on technology companies, ongoing concerns about economic growth rates, and geopolitical tensions have all contributed to investor caution. The Chinese yuan has also faced depreciation pressure at various points, particularly during periods when the Federal Reserve maintained high interest rates, while Chinese authorities pursued easier monetary policy. Into this environment, gold offers several attractive attributes from a Chinese investor's perspective. It's tangible, has no counterparty risk, and exists outside the banking system. It cannot be devalued by corporate mismanagement or regulatory intervention. Most importantly, for Chinese buyers, physical gold held domestically offers protection against both domestic economic instability and potential restrictions on moving wealth across borders. The memory of past capital controls and the reality of current restrictions on foreign investment make domestically held physical assets particularly valuable. The Shanghai Gold Exchange reported withdrawals, a proxy for physical demand, reached approximately 350 metric tons during 2024, representing a substantial increase compared to historical averages of around 1,800 to 2,000 metric tons per year during the 2015 to 2020 period. These withdrawals represent gold leaving the exchange system and entering private hands, jewelry fabrication, or industrial use. When withdrawal numbers substantially exceed imports plus domestic production, it indicates that existing stocks within the exchange system are being depleted, creating upward pressure on prices. Chinese central bank purchases add another layer of demand. The People. This Bank of China reported adding approximately 225 metric tons to its official gold reserves during 2023. The combination of household demand, central bank accumulation, and the structural shift away from property as a wealth store creates a demand profile that isn't easily satisfied by marginal price increases. These aren't traders making leveraged bets who will disappear when prices rise. These are fundamental buyers seeking to allocate wealth into physical assets, willing to pay premiums to ensure delivery and domestic possession. If the Shanghai premium represents a clear profit opportunity, why hasn't the market eliminated it? The answer lies in the complex web of regulations, logistics, and capital controls that govern physical gold movement into China. These aren't temporary obstacles. They represent deliberate policy choices and physical realities that cannot be wished away by market forces. China controls gold imports through a limited number of authorized commercial banks. As of early 2025, approximately 15 to 20 institutions hold licenses to import gold into China. These banks must apply for and receive specific import quotas. The quota system allows Chinese authorities to monitor and manage the volume of gold entering the country, maintaining oversight of what is effectively a capital inflow. While authorities generally approve economically justified imports, the application and approval process takes time and creates administrative friction that does not exist when moving gold between London and New York or between Zurich and London. The refining requirement adds both time and cost. London Good delivery bars, the standard form in Western markets, contain a minimum of 99.5% gold. Shanghai Gold Exchange specifications require 99.99% purity, designated as 4 nines gold. Converting London bars to Shanghai standards requires sending them to a refinery, melting them down, refining out the additional impurities, which are typically silver and copper, and casting new bars to Chinese specifications. Each bar must then be assayed and certified. This process typically takes 2 to 4 weeks and costs approximately $1 to $2 per ounce, depending on refinery capacity and demand. Transportation presents its own challenges. Physical gold moves by secure transport, typically by air for valuable shipments where speed matters. A single pallet of gold bars can contain 1 metric ton, worth approximately $90 million at current prices, around $2,900 per ounce. Moving meaningful quantities requires specialized security, insurance that can cost 0.1% to 0.2% of shipment value, and coordination with customs authorities on both ends. During the period from late 2024 into early 2025, some reports from market participants indicated wait times of 4 to 8 weeks from initiating a shipment in London to final delivery in Shanghai, compared to historical norms of 2 to 3 weeks. The capital control dimension adds a less visible but critically important constraint. When a Chinese entity purchases gold from a foreign source, the transaction typically involves converting yuan to dollars or another foreign currency, transferring that currency abroad, purchasing the gold, and then importing the physical metal. Chinese authorities monitor these transactions as part of their broader capital account management. While gold imports for commercial purposes are generally approved, the process involves documentation, compliance checks, and regulatory oversight that add time and create capacity constraints. Market participants have reported instances during peak premium periods where the bottleneck was not the availability of gold in London or the willingness of Chinese buyers to pay, but rather the capacity of the import and delivery system to process additional volume. This represents a fundamental difference from purely financial markets where settlement is electronic and instantaneous. Physical gold moves slowly, and the infrastructure for moving it has definite capacity limits. Some estimates from industry sources suggest that the maximum practical rate of gold imports into China, given current infrastructure and regulatory processes, ranges between 100 and 150 metric tons per month. When domestic demand exceeds this rate, plus domestic mine production of approximately 30 to 35 metric tons per month, the Shanghai premium must rise to the point where it either reduces demand, increases domestic supply from recycling and dishoarding, or both. The premium, in this view, isn't a market inefficiency. It's the market's mechanism for rationing limited supply among eager buyers. While Shanghai deals with scarcity of physical metal and premiums reflecting delivery constraints, Western gold markets face their own distinct set of tensions. These tensions don't manifest as premiums over spot prices. Instead, they appear in the relationship between paper gold contracts and physical delivery, in the declining inventories at key storage facilities, and in the growing questions about whether the massive paper gold market remains adequately backed by physical metal. COMEX. Gold futures have long served as a primary price discovery mechanism and hedging tool for the global gold market. The exchange offers highly liquid contracts allowing participants to gain gold exposure without dealing with physical metal. On an average trading day, COMEX gold contracts representing 20 million to 40 million ounces change hands, equivalent to 600 to 1,200 metric tons. This dwarfs the physical gold actually mined globally each day, which totals roughly 13 metric tons. The vast majority of COMEX contracts are settled financially, with buyers and sellers closing positions before delivery dates and settling the profit or loss in cash. However, COMEX also allows for physical delivery. Contract holders who maintain positions into the delivery month can demand or be required to deliver 100-ounce gold bars from approved depositories. The eligible gold inventory, metal available for delivery against contracts, fluctuates but has shown concerning trends. During 2020, COMEX eligible gold inventories reached approximately 37 million ounces. By late 2024, that number had declined to approximately 19 million to 21 million ounces, representing a reduction of more than 40% over a 4-year period. This decline occurred while open interest, the number of outstanding futures contracts, remained elevated. In late 2024 and early 2025, COMEX gold open interest frequently exceeded 400,000 contracts, representing 40 million ounces of gold. The ratio of open interest to eligible inventory, while not a perfect measure of systemic risk since most contracts settle financially, has risen from approximately 1.1 in 2020 to ratios approaching 2.0 or higher in recent months. This means the paper claims on gold exceed the physical gold available for delivery by increasingly wide margins. Actual delivery requests have increased notably. During 2023, physical deliveries on COMEX totaled approximately 15 million ounces, substantially higher than the 5 million to 8 million ounces typical of the 2015 to 2019 period. This trend continued into 2024. Some market observers interpret this as evidence that participants are losing confidence in paper gold and increasingly demanding physical settlement. Others note that much of the delivery activity involves transfers between related entities or repositioning of metal between storage locations, not necessarily removal from the system entirely. The London market, traditionally even more opaque than COMEX, has also shown signs of stress. The London Bullion Market Association reported that allocated gold holdings, specific bars assigned to specific owners, totaled approximately 9,800 metric tons as of late 2024, down from peaks above 10,500 metric tons in 2020 and 2021. Unallocated holdings, where clients have claims on gold but not to specific bars, are harder to track, but market participants estimate they represent claims on several thousand additional metric tons. The key concern centers on the ratio between physical metal and claims on metal. In a fractional reserve system, which both COMEX and London's unallocated system effectively represent, there are always more claims than physical metal. This works fine as long as only a small percentage of claim holders demand physical delivery simultaneously. But if a crisis of confidence develops, or if a large percentage of participants simultaneously decide they want physical rather than paper exposure, the system faces potential stress. Some analysts argue that the persistent Shanghai premium reflects a global market in the early stages of physical shortage, where Eastern buyers willing to pay cash for immediate delivery are pulling metal out of Western vaults faster than mining supply replaces it. This view holds that Western paper markets have created an illusion of abundant supply, while physical metal has become increasingly scarce. The counterargument emphasizes that total identified gold holdings globally, including central bank reserves, ETF holdings, and reported commercial stocks, still exceed 200,000 metric tons. Shortage, in this view, is not absolute, but rather reflects friction in moving gold between jurisdictions and forms, from unallocated to allocated, from London bars to Shanghai bars, from west to east. The east-west dislocation in gold pricing cannot be fully understood through pure market mechanics. The phenomenon sits at the intersection of monetary policy divergence, geopolitical tension, and the gradual evolution of the international monetary system away from dollar hegemony toward a more multipolar structure. Gold's unique role as both a commodity and a monetary asset means that large-scale price dislocations carry implications beyond the bullion market itself. China's accumulation of gold, both by its central bank and by private citizens, occurs against the backdrop of the world's largest foreign exchange reserves, which exceeded $3.2 trillion as of late 2024. Approximately 60% to 70% of those reserves are estimated to be held in dollar-denominated assets, primarily U.S. Treasury securities. This concentration creates strategic vulnerability. Economic sanctions, financial system exclusions, or currency devaluation all pose risks to the value of these holdings. Gold offers an alternative reserve asset with no issuing government, no default risk, and universal acceptability. The official Chinese gold reserves stood at approximately 2,264 metric tons as of the last reported figures in 2024, representing roughly 4% to 5% of total reserve assets. By comparison, the United States holds approximately 8,133 metric tons, representing roughly 70% to 75% of its reserve assets, though the U.S. reserve total is much smaller in absolute dollar terms. Germany holds approximately 3,952 metric tons, representing about 70% of its reserves. France holds approximately 2,436 metric tons, also representing about 70% of reserves. The pattern is clear. Western central banks have much higher gold to total reserves ratios than China. If China's long-term objective involves moving its gold holdings closer to Western central bank percentages, it would need to acquire thousands of additional metric tons over coming years and decades. At 225 metric tons per year, the pace reported during 2023, reaching even 10% of reserves in gold would take more than a decade. Accelerating that timeline requires either faster purchases, which risk moving the global gold price significantly higher, or conducting purchases quietly to avoid market impact. Either way, sustained Chinese demand represents a structural feature of the gold market for the foreseeable future. Beyond central bank policy, the geopolitical dimension manifests in the gradual development of alternative trading and settlement systems. The Shanghai Gold Exchange quotes prices in yuan, not dollars. Transactions settle in yuan. For countries seeking to reduce dollar dependence in their international trade and finance, a yuan-denominated gold market offers a potential alternative. Russia, after facing Western sanctions beginning in 2014 and intensifying in 2022, has been reported to trade gold with China, using it as part of bilateral trade settlement mechanisms. While the scale of such transactions remains unclear, the principle is significant. Gold can function as a bridge currency in trade between nations seeking to minimize dollar exposure. The premium itself carries monetary implications. If Shanghai consistently trades at a premium to London, it suggests that yuan-denominated gold claims are valued more highly than dollar-denominated gold claims by marginal buyers. This could reflect expectations of yuan appreciation, expectations of dollar depreciation, or simply higher demand for physical gold accessible within Chinese regulatory jurisdiction. Whatever the precise cause, a sustained premium creates a bifurcated pricing regime, where the same asset trades at different prices depending on currency and regulatory domain. Some analysts draw parallels to the gold market of the 1960s, when official government transactions occurred at $35 per ounce, while free market gold traded at premiums, ultimately leading to the collapse of the Bretton Woods system in 1971. The comparison is not perfect since current markets do not involve official price fixing. However, the broader point holds. When a monetary asset trades at persistently different prices in different jurisdictions, it signals underlying tensions in the monetary system that may eventually require resolution through price adjustment, policy changes, or systemic reform. Beneath the headline numbers of physical demand and geographic premiums lies a complex ecosystem of derivative instruments, leverage positions, and trading strategies that amplify market moves and create additional channels for stress. The paper gold market, vastly larger than the physical market, intersects with the physical dislocation in ways that can either stabilize prices through arbitrage or amplify volatility through forced liquidations and position adjustments. Gold futures open interest on COMEX, as noted, frequently exceeds 400,000 contracts. But futures represent only one form of derivative exposure. Options on gold futures add another layer, with open interest often exceeding 300,000 contracts across various strike prices and expiration dates. Over-the-counter gold forwards, swaps, and options traded between banks and their clients likely represent notional amounts several times larger than exchange-traded derivatives, though precise figures remain opaque due to limited reporting requirements. Much of this derivative activity involves hedging by gold producers, jewelry manufacturers, and investors seeking price exposure without physical possession. These uses generally contribute to market stability. However, derivatives also enable leverage speculation. A futures contract requires initial margin of roughly 5% to 10% of notional value, allowing traders to control large gold positions with relatively small capital outlays. Options can provide even higher leverage, particularly for out-of-the-money calls and puts where premiums are small relative to potential payoffs. When gold prices move sharply, leveraged positions face margin calls. Traders must either post additional collateral or close positions. During periods of rapid price increases, short sellers, betting on price declines, face potentially unlimited losses and may be forced to buy back contracts at elevated prices, accelerating the upward move in a short squeeze. Conversely, during sharp declines, leveraged long positions may be liquidated, pushing prices lower faster than fundamental supply and demand would dictate. The Shanghai premium creates a specific technical challenge. Market makers and arbitrage traders who simultaneously hold positions in Shanghai and COMEX or London markets expect those positions to move largely in sync. When the premium widens unexpectedly, it creates basis risk, the risk that the price differential between related instruments moves against the trader's position. Managing this risk requires either accepting the loss, closing positions, or hedging with additional instruments, all of which can affect market liquidity and pricing. Gold lease rates, the cost of borrowing physical gold, provide another window into market stress. In normal conditions, gold lease rates are extremely low, often below 0.5% per year, reflecting the abundance of gold available to lend and the limited demand to borrow it. However, when physical gold becomes scarce or when traders urgently need metal for delivery, lease rates can spike. During late 2024, one-month gold lease rates periodically reached levels above 2% to 3%, elevated compared to the sub-1% levels typical of the 2015 to 2020 period. While not at the extreme level seen during past crises, these elevated lease rates signal tightness in the physical market and increased cost for traders needing to source gold quickly. Exchange-traded funds backed by physical gold represent another critical piece of market infrastructure. Funds like GLD and IAU hold approximately 1,000 metric tons and 500 metric tons respectively, with total global gold ETF holdings exceeding 3,000 metric tons as of late 2024. These funds create and redeem shares based on investor demand, with creation requiring delivery of physical gold to fund vaults and redemption resulting in gold leaving those vaults. During periods of strong investment demand in the West, gold flows into ETFs, removing it from the available supply for industrial use or Eastern market purchases. Conversely, when Western investors redeem ETF shares, gold becomes available for other uses. Throughout 2024, gold ETF flows were mixed, with North American and European funds experiencing modest net outflows during some months and modest inflows during others. The lack of strong, sustained inflows into Western gold ETFs, despite gold prices reaching new all-time highs above $2,900 per ounce by late 2024, suggests that the price advance has been driven more by Eastern physical demand and central bank purchases than by Western investment demand. This geographic split in demand sources contributes to the dislocation, as Eastern buyers seek physical delivery while Western positioning remains more oriented toward financial exposure through derivatives and ETFs. When a globally traded commodity begins exhibiting persistent price differences across major markets, it raises a fundamental question. What is the real price? Is gold worth the COMEX settlement price, the London fixing price, or the Shanghai premium price? The answer has implications not just for traders, but for anyone using gold as a reference point for monetary value, portfolio allocation, or economic analysis. Traditionally, London and New York have served as global price-setting centers for gold. The twice-daily London gold fixing, a process involving major bullion banks establishing a clearing price for buy and sell orders, has existed in various forms since 1919. COMEX futures, through their deep liquidity and transparent pricing, provide continuous price discovery during U.S. trading hours. These prices are quoted in dollars and serve as global benchmarks. Shanghai's emergence as a major gold trading center, particularly following the 2014 launch of the Shanghai International Gold Exchange, which allows foreign participation, created an alternative pricing mechanism. Prices in Shanghai reflect yuan-based bids and offers for physical gold delivered in China. Converting Shanghai prices to dollars requires applying the yuan-dollar exchange rate, adding another variable that can cause apparent price differences even when gold values are identical. However, the premiums discussed in this analysis are calculated after adjusting for exchange rates and represent genuine price differences for equivalent gold. When Shanghai trades $30 per ounce above COMEX after currency conversion, it means buyers in China are paying $30 more for the same refined gold bar. This creates a philosophical and practical problem. Which price represents reality? One perspective holds that the physical delivery price, the price at which actual metal changes hands, represents the true price. By this logic, Shanghai's premium reflects real market conditions, while COMEX and London prices, heavily influenced by paper trading and derivative positioning, understate gold's actual scarcity value. Proponents of this view argue that if COMEX cannot source sufficient physical gold to satisfy delivery demands at its quoted price, then that price is an illusion sustained by financial engineering rather than physical reality. The opposing view emphasizes liquidity and accessibility. COMEX and London markets allow participants to trade hundreds of metric tons worth of exposure in seconds with minimal market impact. Shanghai's premium, in this interpretation, reflects local market conditions, regulatory friction, and the costs of accessing Chinese markets rather than universal gold scarcity. The fact that gold can be sourced in London at lower prices proves that gold is not scarce globally, only scarce within China's regulatory borders. A third perspective suggests that both prices are real, reflecting genuinely different products. Gold in London is gold accessible to global markets, freely tradable, encumbered by minimal regulation. Gold in Shanghai is gold within Chinese regulatory jurisdiction, subject to Chinese laws, and offering specific attributes valuable to Chinese holders. These aren't precisely the same product despite being the same physical substance, so different prices are economically rational. The price discovery debate extends beyond philosophy to practical concerns. Mining companies use gold prices to determine which deposits are economical to develop. Investors allocate capital based on expected returns calculated from market prices. Central banks mark their gold reserves to market values. If prices diverge significantly and persistently between major markets, these calculations become more complex and potentially unreliable. Some analysts forecast that continued divergence could lead to the emergence of regional price regimes, where gold trades in a price range in Asia, a different range in the West, with limited arbitrage bridging the gap. This wouldn't be unprecedented. Prior to modern transportation and communication, commodity prices often varied substantially between regions. What would be unprecedented is such fragmentation occurring for a highly valued, easily transported commodity in an era of global finance and instant communication. The resolution could come through several channels. Increased import capacity into China, whether through regulatory relaxation or infrastructure investment, could ease the physical bottleneck and reduce premiums. Alternatively, sustained high premiums could incentivize enough gold production and recycling within China to reduce import dependence. A third possibility involves Western prices rising to meet Eastern prices if physical demand globally exceeds available supply. Finally, macroeconomic changes that reduce Chinese demand, such as stabilization in property markets or attractive alternative investments, could eliminate the premium from the demand side. The persistence and magnitude of the Shanghai gold premium signals that the current situation represents more than a temporary market anomaly. It reflects structural changes in global gold demand patterns, the rise of Asia as the dominant source of physical gold consumption, and the increasing divergence between paper gold markets and physical gold markets. Understanding possible future developments requires examining scenarios ranging from gradual normalization to more disruptive outcomes. The normalization scenario assumes that current conditions represent a transitional phase. Chinese demand, elevated by property market distress and economic uncertainty, will moderate as alternative investments become more attractive or as gold prices rise enough to curtail purchasing. Meanwhile, supply-side adjustments, including expanded import infrastructure and increased domestic recycling, will reduce bottlenecks. Premiums narrow back to historical levels below $10 per ounce, and Western price-setting mechanisms regain primacy. Global gold markets return to the pre-2020 pattern of tight integration and minimal geographic arbitrage opportunities. This scenario faces several challenges. Chinese household demand for gold appears to reflect not just cyclical economic concerns, but structural shifts in wealth allocation away from property toward alternative stores of value. Demographic factors, including an aging population seeking wealth preservation, support sustained gold demand. Geopolitical tensions show little sign of abating, maintaining the strategic rationale for both official and private gold accumulation. Supply-side constraints, particularly the import quota and refining capacity limitations, cannot be eliminated without policy changes that Chinese authorities may be reluctant to implement if they value control over gold flows. A second scenario involves persistent dual pricing, where Shanghai consistently trades at a premium to Western markets, establishing a new normal in global gold trading. The premium might stabilize at a level that balances Chinese demand against available import capacity, perhaps in the $20 to $40 per ounce range. Western and Eastern gold markets remain connected through limited arbitrage flows, but increasingly function as semi-independent pricing systems. This creates complexity for global market participants, but does not necessarily imply systemic instability, as long as the premium remains predictable and both markets function smoothly within their respective jurisdictions. This scenario's viability depends on whether participants can adapt to operating in a bifurcated market. Mining companies might negotiate different pricing for output destined for Eastern versus Western markets. Investors might explicitly choose between accessing gold through Western paper markets at lower prices or paying premiums for Eastern physical exposure. Central banks might arbitrage the difference, selling gold at premium Shanghai prices and replacing it with cheaper London purchases, though this would require navigating capital controls and political sensitivities. A more concerning scenario involves cascading stress, where the physical paper disconnect in Western markets reaches a breaking point. If enough COMEX contract holders demand physical delivery simultaneously, eligible inventories could be depleted, forcing cash settlement at elevated prices or contract defaults. Such an event would severely damage confidence in paper gold markets, and likely cause a sharp spike in gold prices as participants fled to physical metal or jurisdictions perceived as having adequate physical backing. The Shanghai premium could explode to hundreds of dollars per ounce as Chinese markets, already oriented toward physical delivery, appear safer than Western markets facing delivery failures. This scenario remains a tail risk rather than a base case. COMEX has mechanisms to manage delivery stress, including raising margin requirements to discourage speculative delivery demands, encouraging cash settlement through price adjustments, and working with depositories to source additional metal if needed. However, the declining eligible inventory trend and increasing delivery activity suggest the system is moving closer to its operational limits rather than further from them. A fourth scenario considers the possibility of policy intervention to address the dislocation. Chinese authorities could relax import quotas, streamline approval processes, or even remove import restrictions entirely, allowing market forces to eliminate the premium through free arbitrage. Alternatively, Western central banks could coordinate releases of gold into the market to ease physical tightness, similar to strategic petroleum reserve releases during energy crises. Such interventions would directly address supply constraints, but would require acknowledging that the current situation poses systemic risks, warranting official action. Policy intervention faces political and economic obstacles. China derives strategic value from controlling gold flows and maintaining oversight of citizens' international capital movements. Removing gold import restrictions could open channels for capital flight and reduce policy flexibility. Western central bank gold sales would require public justification and might be perceived as desperation, potentially accelerating rather than calming market stress. Moreover, if underlying demand fundamentals remain strong, policy interventions might provide only temporary relief unless sustained over time. The East-West gold dislocation carries practical implications for various market participants, from individual investors to multinational corporations to policymakers. Understanding these implications requires examining how the phenomenon affects portfolio decisions, hedging strategies, and broader economic outcomes. For individual investors, the key question is whether gold exposure should be through physical metal, ETFs, futures, or other derivatives, and whether geographic considerations matter. An investor purchasing a gold ETF like GLD receives exposure to gold prices as determined primarily by Western markets. If Shanghai premiums persist or widen, this exposure might underperform direct ownership of physical gold that could potentially be sold into Asian markets at premium prices. However, physical ownership involves storage costs, insurance, and liquidity constraints that ETFs avoid. The optimal choice depends on investment horizon, risk tolerance, and views on whether the current dislocation persists or resolves. Investors specifically seeking exposure to physical gold scarcity might consider vehicles that emphasize physical backing and delivery options. Some smaller ETFs and closed-end funds offer shareholders the ability to redeem shares for physical metal. Others hold allocated gold in specific jurisdictions. While these products typically charge higher fees than large mainstream ETFs, they provide more direct physical exposure and potentially capture more of the premium if Eastern markets continue paying higher prices for deliverable gold. Mining companies face complex decisions regarding production allocation and pricing strategies. Historically, gold miners have sold output at prevailing spot prices or hedged future production using futures and forward contracts. The emergence of persistent Eastern premiums creates the possibility of negotiating separate pricing for output destined for different markets. However, executing such strategies requires navigating currency risk, counterparty risk, and the operational complexity of splitting production between markets. Companies with diversified geographic sales may benefit from the premium by directing more output to Asian customers, while those locked into Western sales contracts may miss out on the enhanced pricing. Central banks managing gold reserves face particularly nuanced considerations. The Shanghai premium theoretically allows central banks to sell gold at elevated Eastern prices and replace it with cheaper Western purchases, earning a risk-free profit. In practice, such operations involve significant transaction costs, regulatory hurdles, and political sensitivities. Moreover, central banks generally hold gold for strategic stability rather than trading profit, making opportunistic arbitrage inconsistent with institutional mandates. However, central banks adding to reserves must decide whether to source gold from Western markets at lower prices, accepting slower delivery timelines, or pay Shanghai premiums for faster acquisition within Asian markets. Jewelry manufacturers and industrial gold users are directly impacted by the dislocation. A Chinese jewelry manufacturer faces higher input costs than a European competitor due to the Shanghai premium. This creates competitive pressure that must be offset through other efficiencies, passed to consumers through higher prices, or absorbed through lower margins. Some manufacturers may explore sourcing strategies that involve importing finished or semi-finished jewelry components rather than raw gold to avoid import quotas, though this introduces complexity and may face its own regulatory barriers. The broader economic implications extend to monetary policy and international finance. If gold's role as an alternative reserve asset grows due to concerns about fiat currency stability, persistent dislocations in gold markets could affect confidence in the international monetary system. Countries holding large dollar reserves might view the combination of Western paper gold markets with declining physical backing, and Eastern physical markets with supply constraints as evidence that the current system lacks adequate, stable alternatives to dollar reserves, potentially affecting their willingness to continue accumulating dollar assets. Alternatively, some analysts argue that the dislocation demonstrates gold's declining relevance in modern finance. If gold cannot be efficiently priced and traded globally despite modern technology and capital markets, it suggests the metal has become a niche asset rather than a central monetary anchor. This interpretation sees the Shanghai premium as evidence of market fragmentation and inefficiency rather than fundamental scarcity, implying that investors and policymakers should look elsewhere for monetary stability. The reality likely falls between these extremes. Gold remains the third largest reserve asset globally after dollars and euros, with central banks worldwide holding approximately 35,000 metric tons worth over $3 trillion. Its role has evolved rather than disappeared, functioning less as a daily transaction medium and more as a crisis hedge and long-term store of value. The current dislocation reflects tensions in how this role operates across different regulatory jurisdictions and monetary systems, tensions that may persist for years as the international financial architecture gradually evolves. For observers of financial markets, the Shanghai gold premium serves as a real-time indicator of stress in the global monetary system. Widening premiums signal increasing Chinese demand for hard assets and growing friction in international capital flows. Narrowing premiums might indicate easing concerns or successful policy adjustments. Monitoring this spread provides insight into dynamics that affect far more than the gold market itself, offering a window into the deeper structural shifts reshaping international finance in an era of great power competition and monetary experimentation. The questions raised by this dislocation have no simple answers. They require ongoing analysis, attention to evolving data, and recognition that the current situation represents not an aberration to be quickly resolved, but rather a manifestation of fundamental tensions in the global financial system that will shape markets and policy for years to come.